Welcome to a new episode of Inside the Economist's Mind. Today we're diving deep into the world of bonds, and more specifically, the yield curve. Now, I know that might sound maybe a bit dry, maybe technical,
hmm
but honestly, understanding this one concept unlocks a surprising amount about how our financial world actually ticks.
Absolutely. It's fascinating, because this graph, the yield curve, it sounds technical, but it's really like a vital sign for the whole economy.
Right.
It influences everything from, say, mortgage rates to big business investment decisions. So, yeah, if you understand it, you definitely gain an edge in reading the economic tea leaves, so to speak.
Precisely. And that's really our mission for this deep dive. By the end, you'll have a clear grasp of what bonds are, that crucial inverse relationship between their prices and yields,
hmm
and really understand why the yield curve is such a closely watched indicator, not just in finance, but for the broader economy too.
Yeah, we'll unpack why it matters for figuring out economic health, where interest rates might be going.
And we're basing this exploration on some great insights from the Reserve Bank of Australia.
That's right.
So let's jump right in. Start at the beginning. What exactly is a bond?
Okay, so think of a bond basically as a formal IOU. You, the investor, lend money to someone else.
Like a government or a company?
Exactly, typically a government or a corporation. And they promise two main things. To pay you back the original amount, that's the principal,
Mhm.
after a set amount of time. That time is called the term to maturity.
Okay, term to maturity. And the second thing?
And usually during that term, they make regular interest payments to you, like rent for using your money.
So it's essentially a structured loan. And that term, the maturity, it could be short, like a few months, or
Yeah,
maybe
yeah.
long.
Yeah, exactly.
Right.
It can be very short, can be decades, 30 years, even longer sometimes. But here's a really key difference from just a regular loan you might get from a bank.
Okay.
Bonds can be bought and sold between investors after they've been issued.
So there's a market for them, a secondary market.
Precisely. And this trading gives them a market price, and crucially, that price can fluctuate, goes up and down.
Okay, that's interesting. The RBA gives this example, right? $1 billion government bond, maybe trading hands for $1.01 billion. What would make its price go up like that?
Well, a higher price usually means that bond has become more attractive somehow.
More attractive than when it was first issued.
Yeah. For instance, maybe interest rates out there in the wider market have fallen since that bond first came out.
I see.
So its fixed interest payments suddenly look pretty good compared to what new bonds are offering. Demand goes up, price goes up.
Which brings us perfectly to bond yield. That sounds related to the price changing. How does yield work?
It is very related. The bond yield is basically the total annual return an investor expects to get from that bond over its remaining life.
Okay, total return. So it includes the interest payments.
Yes, the regular interest payments, but it also factors in the difference between the price the investor paid for the bond and the principal amount they'll get back when it matures.
Ah, right. Because you might not pay face value for it in that secondary market.
Exactly. It's a way to standardize the return you're getting, regardless of the price you paid or the fixed interest rate.
So I got this. If I buy a bond for more than its face value, say that $1.01 billion example, my actual percentage return, my yield, will be lower than the original interest rate stated on the bond.
You've got it. That's the key. You paid a premium, right? So that fixed interest payment represents a smaller percentage of your initial outlay. Your overall yield is lower.
And the reverse is true. If I buy it cheap, at a discount.
Yep, buying at a discount means that same fixed interest payment gives you a higher percentage return relative to your cost, boosts your yield.
And from the issuer side, the government or company, what's the yield to them?
Good question. For the issuer, the yield essentially reflects their effective cost of borrowing for that specific chunk of money for that specific term at that specific moment in time.
Okay.
So when the RBA mentions, say, a 0.25% yield on 3-year Australian government bonds, that tells you the annual cost for the government to borrow money for 3 years based on where those bonds were trading at that point.
Okay. Makes sense. And you mentioned the secondary market. We should probably distinguish that from the primary market.
Right. Primary market is where the bond is born, first issued by the government or company directly to the initial investors.
Sets the basic terms.
Exactly. The secondary market is where all the subsequent action happens, investors trading it amongst themselves, and that's where prices and yields are constantly shifting based on, well, everything happening in the economy, market conditions.
Got it. Okay, now for probably the most fundamental concept here. This inverse relationship between bond prices and yields, you hear it all the time, they move in opposite directions. Why? Why is that always the case?
It really boils down to one simple fact. Those interest payments, the coupons, they're fixed.
Set in stone when the bond is issued.
Exactly. They don't change. But what does change constantly is the general level of interest rates in the market. What investors require as a return for lending their money. That changes based on economic forecasts, central bank actions, all sorts of things.
Okay, fixed payment, but changing market rates. So
Yeah.
if market interest rates fall, those older bonds, the ones that were issued earlier with higher fixed payments, they suddenly look much better.
Precisely. The RBA uses this exact scenario. If new bonds are coming out paying, say, 1% interest because rates have fallen, but you've got an older bond still paying 2%.
Everyone wants the 2% one.
Right. Demand for that older, higher-paying bond goes up. And when demand goes up,
The price goes up.
the price goes up.
But wait, if I'm the one buying it now at that higher price, I'm still only getting that same fixed $2 payment or whatever it is.
Yeah.
So relative to my higher purchase price,
Mm-hmm.
my return is lower.
That's it. Your yield goes down. You paid more for the same income stream. It's like paying more for a rental property. The rent check is the same, but your percentage return on your investment is lower because you paid a higher purchase price.
That's a great analogy. Higher price, lower yield.
Okay.
The RBA has this little box, bond prices and yields.
Yeah.
An example. Maybe walking through that would really nail it down.
Yeah, let's do that. It makes it very concrete.
Okay.
So imagine the government issues a 10-year bond. Face value, let's say $100, and it pays 2% interest each year. So that's a $2 coupon payment annually.
Simple enough. $100 bond, $2 a year for 10 years.
Right. Now, scenario one. At the time it's issued, the general market yield for similar 10-year government debt is also 2%.
So everything matches.
Everything matches. In this case, the bond will trade right at its face value. Price is $100. Yield is 2%. No surprises.
Makes sense. Okay.
Now, scenario two. Some time passes. Things change. Let's say investors now only require a 1% yield for holding a 10-year government bond. Maybe they expect the economy to slow or the central bank to cut rates.
Okay, market expectation drops to 1%.
But our bond, it's still chugging along, paying out that fixed $2 every year.
Which looks really good compared to the 1% investors are now demanding elsewhere.
Exactly. It's paying double what the market currently requires for that level of risk and duration. So investors will bid up the price of our bond. They'll pay more than $100 for it.
And the example says the price goes up to, what, $109.50?
Precisely. And why that specific price? Because at $109.50, receiving that fixed $2 annual payment gives the new buyer an annual return, a yield of approximately 1%.
So the price adjusted upwards until the yield for the new buyer matched the new prevailing market yield of 1%.
You nailed it. Price went up, yield came down. That's the inverse relationship in action, driven by the fixed coupon and the changing market yield expectations.
Got it. Crystal clear now. Price is up, yields down, vice versa. Okay, let's move on to the yield curve itself. We hear this term all the time in financial news. What is the yield curve?
Right. The yield curve, sometimes called the term structure of interest rates, it's actually pretty straightforward in concept. It's just a graph.
A graph showing what?
It shows the yields on bonds with different lengths of time until they mature different terms to maturity.
Okay.
And critically, when people just say the yield curve, they almost always mean the curve for government bonds.
Gotcha. Not corporate bonds. So it's like a visual comparison of the government's borrowing cost for, say, 1 year versus 5 years versus 10 years.
Exactly that. You plot the yields for government bonds of various maturities, maybe 3 months, 1 year, 2 years, 5, 10, 30 years on a graph.
And how's it laid out?
Usually, time to maturity runs along the bottom, the horizontal x-axis, from short-term on the left to long-term on the right.
Okay.
And the yield, the interest rate, runs up the vertical axis.
And the RBA mentioned the central bank's main policy rate, the cash rate in Australia's case, that sort of sets the starting point.
Yeah, that's the anchor for the very, very short end of the curve. Because the cash rate is basically the rate for overnight borrowing, the shortest term imaginable.
Right.
And because we're focusing on government bonds, this curve is often called the risk-free yield curve.
Risk-free because the government is highly unlikely to default on debt in its own currency.
That's the idea. The credit risk is considered negligible.
And just to circle back, corporate bonds, they do have default risk, so they aren't on this main curve, and they generally have higher yields to compensate investors for taking on that extra risk.
Correct, absolutely. That difference in yield, the spread between a corporate bond and a government bond of the same maturity, that's a really important indicator itself. Tells you about perceived credit risk in the market.
Okay, fascinating. So we have the curve plotted. Now let's talk shapes. It's not always the same shape, is it?
Yeah.
Normal, inverted, flat. What does these tell us?
Right. The shape is crucial. There are really two main aspects to look at, the overall level of the curve and its slope.
Level and slope.
Okay. The level just refers to the general altitude of interest rates. Is the whole curve high or low? And that's heavily influenced by the central bank's policy rate, the cash rate.
So if the central bank hikes the cash rate, the whole curve tends to shift upwards.
Generally, yes. It tends to pull the whole structure up, especially the short end, but usually the whole thing moves somewhat in parallel.
Okay, that's the level. What about the slope? That sounds like where the different shapes come in.
Exactly. The slope is the difference between short-term yields and long-term yields. And this is where you get really valuable information about investor expectations, future rates, economic health. It's baked into the slope.
Okay. The RBA points out three main shapes.
Mhm.
Let's start with a normal one. What's a normal yield curve look like?
A normal yield curve slopes upwards.
So low yields on the left, short term, higher yields on the right, long term.
Correct. Short-term bonds have lower yields than long-term bonds. And it's called normal because, well, it makes intuitive sense.
Why is that?
Investors usually demand extra compensation for tying their money up for longer. There's just more uncertainty way out in the future, right? Uncertainty about inflation, about future interest rate moves. So they want a higher yield, a term premium for taking on that longer-term risk.
So it's like getting paid extra for the uncertainty of time.
Pretty much. And you often see this normal upward sloping curve during periods of economic expansion.
Why then?
Because in a growing economy, people often expect that the central bank might need to raise interest rates down the track to keep inflation in check. So expectations of future higher short-term rates get built into today's long-term rates.
Ah, okay. Normal curve, upward slope, often seen in good economic times.
Yeah.
Got it. Now, what about the opposite, an inverted yield curve? That sounds less normal,
It is less common, and it definitely gets attention. An inverted curve slopes downward.
meaning short-term yields are higher than long-term yields.
Exactly. The front end of the curve is higher than the back end.
Why would that happen? It seems counterintuitive to get paid less for lending longer.
It does. It usually suggests that investors expect policy interest rates to be lower in the future than they are today.
And why would they expect lower rates down the line?
Well, the typical reason is that the market anticipates an economic slowdown, maybe even a recession.
Ah, because if a recession hits,
Central banks usually cut interest rates to try and stimulate the economy. So if investors think rate cuts are coming, they expect future short-term rates to be lower. That expectation pushes down today's long-term yields relative to current short-term yields.
I see. So historically, this inverted curve has sometimes been seen as a warning sign. Especially in the U.S., the RBA notes.
Yes, particularly in the U.S., an inverted yield curve has often preceded economic contractions. It's not a perfect predictor, there's debate about timing and reliability, but it's definitely a signal that market participants are becoming pessimistic about future growth.
Okay, so downward slope, short rates higher than long rates, potential warning sign of weaker times ahead.
Yeah.
What about the third shape? Flat.
A flat yield curve is pretty much what it sounds like. Short-term yields and long-term yields are very similar. The line on the graph is almost horizontal.
What does that suggest?
The RBA suggests it can be a transitional phase. Maybe the curve is moving from normal to inverted, or vice versa.
Kind of in between.
Yeah. Or you might see it when overall interest rates are already very low. Or sometimes it can be a result of specific central bank policies, what they call unconventional policies. Generally, it suggests uncertainty or a lack of strong conviction in the market about where things are headed next.
Okay. The RBA's pictures of these shapes really help visualize it. Normal up, inverted down, flat. Well, flat. Now we know what it is, what the shapes mean. But why is it important? Why should listeners care about this curve?
Oh, it's hugely important for several reasons. Firstly, it's a key part of how monetary policy actually works, how it gets transmitted through the economy.
How so?
Well, the central bank controls the very short end, the cash rate. Changes there ripple out along the curve. And the yields along that curve directly influence borrowing costs for almost everyone.
For households taking out mortgages?
Absolutely. Especially fixed-rate mortgages. The rate you get offered for a 3-year or 5-year fixed mortgage is going to be closely linked to the government bond yield for that same maturity. Same for businesses borrowing to invest, or even the government itself when it borrows.
So the central bank moves the short end, but the whole curve affects the actual cost of money for different lengths of time.
Exactly. It impacts decisions about spending, investment, saving. everything.
Direct impact on borrowing costs.
Yeah.
That's one big reason. What else?
Second, as we've kind of touched on with the shapes, the slope is seen as a really valuable leading indicator
Leading indicator of what?
of market expectations. Financial markets are always trying to look ahead, right? The yield curve bundles up the collective wisdom or maybe bets of all those investors about where things are going. Future interest rates, future economic growth, future inflation.
So that inverted curve isn't just a statistical quirk. It's the market shouting, hey, we think trouble might be brewing.
In a way, yes. It's a powerful signal, even if it's not always perfectly accurate. It tells you about sentiment and expectations.
Okay, monetary policy transmission. Leading indicator of expectations.
Yeah. Is there a third reason?
Yep. Bank profitability.
How does the yield curve affect how much money banks make?
Well, the traditional banking model, simplified, is borrowing short and lending long.
Taking in deposits, which are usually short-term,
Right, paying short-term interest rates on deposits or other funding.
and lending out money as longer-term loans, like mortgages.
Exactly, charging longer-term interest rates.
Yeah.
So if you have a normal upward-sloping yield curve,
Where long-term rates are higher than short-term rates.
that gap, that spread between their borrowing cost and their lending income is wider, which is generally good for their profit margins.
Makes sense. Borrow low, lend high. But the
Yeah.
RBA adds a little caveat for Australia here, doesn't it?
It does. It notes that this effect might be less pronounced in Australia compared to, say, the U.S.
Why is that?
Because in Australia, a very large chunk of mortgages are variable rate, not fixed. So they reset frequently based on short-term rates, like the cash rate.
Pretty much. So the direct link between the slope of the yield curve and Australian bank profits might not be as strong as in places like the U.S., where long-term fixed-rate mortgages are much more common. The level of rates still matters hugely, of course.
Interesting distinction. Okay, so we know why it's important. Let's dig into what actually causes it to change. What makes the yield curve shift its level or change its shape? The RBA lists a few key drivers, starting with the obvious one: monetary policy changes.
Yep, central bank actions are front and center. Standard, conventional policy changes like lifting or cutting the main policy rate, the cash rate usually cause the whole curve to shift up or down.
A parallel shift, mostly, affecting all maturities.
Largely, yes, though the short end tends to react most directly, obviously.
Okay. But then there's unconventional monetary policy, stuff we heard more about after the financial crisis and during the pandemic. How does that affect the curve?
Right. Unconventional tools can have more targeted effects. Negative interest rates, for example, if used, would obviously push the whole level down, maybe even below zero for some maturities.
Okay. What about forward guidance, when the bank promises to keep rates low for a while?
Forward guidance aims to influence expectations about future rates. By committing to keep short-term rates low, it can help hold down yields further out along the curve, potentially flattening it, especially in the short to medium-term part.
And asset purchases. Quantitative easing, or QE, when the central bank buys bonds.
QE directly impacts supply and demand. When the central bank buys lots of bonds, particularly longer-term ones, it increases demand for those specific bonds.
Pushing their prices.
And their yields down, exactly. So large-scale asset purchases can specifically target and lower longer-term yields, which tends to flatten the curve by squashing that term premium we talked about. Sometimes central banks even target a specific yield level for a certain maturity.
So central banks have quite a few levers, conventional and unconventional, to influence the yield curve's level and shape. What's another major factor?
Changes in how investors perceive risk. This is huge.
What kinds of risk?
Several types. First, credit risk, the chance the borrower won't pay back. As we said, for government bonds in their own currency, this is usually seen as very low.
Okay.
Then there's liquidity risk. Can I sell this bond easily and quickly without losing money on the price?
Is the market deep enough?
Right. Less liquid bonds usually need to offer a higher yield to compensate for that risk. Government bond markets are typically very liquid, though.
And the third risk?
Term risk, or interest rate risk. This is the big one for the curve's shape. It's the risk that interest rates might change while you're holding the bond, affecting its market value. And the longer the bonds turn, the more uncertainty there is about future inflation and interest rates. So investors demand that extra yield, the term premium.
So if suddenly everyone gets more worried about future inflation, they might demand a bigger term premium, pushing up long-term yields relative to short-term ones, steepening the curve.
Precisely. Any news or event that changes perceptions about future economic growth, inflation, central bank policy, or just general uncertainty can alter how investors assess these risks, and that flows through to the yield curve's shape and level.
Okay, central bank policy, risk perceptions. What's the third main driver the RBA highlights?
Good old supply and demand for
But
the bonds themselves.
just like any other market.
Exactly. Basic economics. If demand for bonds goes up, maybe investors get nervous about stocks and rush to the perceived safety of government debt that pushes bond prices up and yields down.
All right, and supply.
If the supply of bonds increases, for example, the government needs to borrow a lot more money to fund spending. That increased supply tends to push bond prices down and yields up, assuming demand stays the same.
And crucially, these supply and demand shifts might not be uniform across all maturities, right? That could change the slope.
Absolutely. Let's say the government suddenly announces a huge increase in issuing 30-year bonds, but doesn't change its issuance plans for short-term debt.
More supply way out at the long end.
Right. That specific increase in supply at the 30-year point would likely push 30-year yields up relative to shorter-term yields. That would make the yield curve steeper, particularly at the long end. The RBA has a nice little diagram showing exactly that for the 10-year market: more supply, lower price, higher yield.
So it's this constant complex dance between central bank signals, shifting investor psychology about risk, and the underlying flow of bond supply and demand that sculpts the yield curve day by day.
That's a perfect way to put it. It's dynamic, and it reflects a huge amount of information and expectation. Understanding these drivers really helps decode what the curve might be telling us.
Well, this has been incredibly helpful. A really thorough deep dive into bonds and that all-important yield curve. Just to quickly summarize, we've seen bonds are essentially loans, but tradable. We've nailed down that critical inverse link: prices up, yields down, and we've explored how the yield curve graphs those yields across different time frames.
Giving us that visual snapshot of borrowing costs and, importantly, market expectations.
Right. And understand it isn't just for finance pros, it affects real-world borrowing costs and gives us clues about where the economy might be headed.
Definitely. It moves beyond just reading the headlines about interest rates. It gives you a framework for thinking about the underlying dynamics.
Which really leads to a final thought for you, our listeners, to ponder. We've talked about monetary policy, risk, supply, demand, all shaping this curve. So considering all those factors, what other global events, maybe emerging trends or perhaps different economic indicators, might you now pay closer attention to when you're trying to figure out why the yield curve looks the way it does today and where it might be heading tomorrow? Something to think about.